Hey everyone, and welcome back to the Stoic Investor, the channel where we help people to achieve long-term sustainable investment return. Today we are going to deep into the topic of a beginner guide to investing from A to Z. So whether you are just starting out or a veteran and want to sharpen your skill set in the stock market, this video is going to be for you. Today we are going to discuss topics like, for instance, diversification, the asset allocation, whether you need a financial advisor, the difference between ETF and stocks, but also dig into bonds and certificate of deposits. So if you are ready to have your money working for you, let's jump into it. First, let's start by answering the most fundamental question. Why should you invest? Well, here is the thing, because if you are not investing, you are basically losing money. You think that by placing money in your bank account, you will achieve a safe bet. But that is not really true, because this is where inflation kicks in. Because even if you place your money in the bank account, the inflation is gonna erode your purchasing power. What does it mean? It means that although the total amount of your money stays the same, how much you can buy with the same amount of money is becoming less and less. This is why it's important to start investing, because with the investment return, you can outpace the inflation by means of the compound interest. What does it mean, compound interest? Well, if you follow this channel, you might be used to hear this term, but let me explain that to you. With the term compound interest, we mean that when your investment starts to earn some returns, those returns earn additional returns, and so on and so on. This is creating a snowball effect that can really change your life. But in order to achieve that, you need to start early in your life and remain consistent. So, how do you actually start investing? Well, in order to start, you need a brokerage account. A brokerage account is basically the means that allow you to buy and sell stocks, ETF, and bonds. You can see that as your gateway to financial markets. Today it's very easy to open a brokerage account compared to the past, as it usually does not require a minimum amount of money deposited, as well as does not require a particularly high commission fee, if not at all. Well-known brokerage account might be Interactive Brokers, Robinhood, DeGiro, and Fidelity, but there are many others around, and you can just pick up the one that suits you best. Once you have opened your brokerage account, then you are ready to start investing your money and create your own portfolio. And now let's move to the other big question. How much should you invest? That really depends on your financial situation, but I will still try to give you some guidelines. Financial experts usually recommend something between 15 and 20% of your income. That might sound quite a lot, especially if you are starting out. But the beauty of investing is that it does not really matter how much you decide to invest, but rather that you keep on doing that consistently. So whether you are starting with $50 a month, $500 a month, or $1,000 a month, it matters more that you keep on doing that consistently. In this way, you achieve two main objectives. First of all, you kick off the compounding effect. And the second objective is that you smooth out market volatility, meaning that if you keep on doing that repeatedly, you don't care about market fluctuation. The dollar cost averaging is a strategy that implies that you decide a fixed amount of money to invest every month, regardless of the market situation. This strategy is very important, especially for beginners, because it takes out all the guesswork related to trying to predict what the market is gonna do. So for instance, let's say that you decide to invest $100 per month, and you decide to do that the 10th of every month. So you're gonna do that and stay consistent to your strategy, to your dollar cost average strategy, every month, regardless of the market situation. For sure, there will be some months where you buy high, other months where you will buy low. But on average, this will allow you to smooth out the market fluctuation and to gain from the consistency of your returns. And now let's talk about one of the two main investments you'll hear about today: stocks and ETFs. Which one is better for beginners? Well, a stock is a piece of ownership of a company and in general of a business, meaning that if the company is increasing its earning, is expanding its business, the market price of that company is set to increase and therefore you are set to earn more money. On the contrary, if the company earnings are decreasing and the business is shrinking, you will probably lose money. This is a rather concentrated type of investment, especially if you own just a few stocks, because you are basically exposed to the fluctuation of the business of those companies. On the other side of the spectrum, we have the ETF, which can be considered as a collection of several stocks. So for instance, if you decide to invest in the S&P 500 ETF, you are basically investing in all 500 largest US companies. This is a great way to achieve diversification, and I would probably recommend ETF over stocks, especially if you are a beginner, because in this way you don't have to track on a monthly, on a quarterly basis the business evolution of a company, but you just need a few ETF to achieve a high degree of diversification. And speaking about diversification, you might be wondering now, okay, but how many assets do I need to have in my portfolio? Well, that really depends on your asset allocation. If you decided to mainly invest in stocks, market research have shown that historically a portfolio of 20-30 stocks is probably one of the best to achieve a high level of diversification while still retaining the possibility to achieve a great return in single stocks. On the other side, if you decided to build your portfolio mainly on ETFs, then I would say that already with just 2-3 ETFs, you can already achieve exposure to probably 100, if not thousands of companies. Another common question I usually receive is the following one. Should I just invest in US companies or look globally? That really depends on you and on your risk appetite. Historically, the US market is one of the best performers in the world. However, that might be quite risky to invest just in US companies. Have you thought about what can happen to your portfolio if US enter into a recession and the US stock market plunges for 2 or 3 consecutive years? And this is where geographical diversification kicks in. So investing also in emerging markets or in Europe or in Asia allow you to preserve your wealth and the stability of the returns in your portfolio. And now let's discuss about more safe type of investment. We have, for instance, bonds, by means of which you are lending money to governments or companies, which in exchange agree to give you periodic interest and at the end of the loan, giving back the money. Also, you can select a certificate of deposit or a bank's saving account, which can allow you a greater degree of diversification, although in this way you are set to earn a smaller interest compared to, for instance, bonds. And now let's talk about one of the most important decisions you will have to make as an investor: the portfolio allocation. Portfolio allocation basically means in how many pieces you decide to cut your pie and how big your pieces are gonna be. But here is the thing: the portfolio allocation doesn't have to be static, meaning that it can vary depending on the opportunities that you can find in the market, on your risk appetite, and on your age. Why your age? Well, because financial experts recommend to tie the portfolio allocation to the time that you have in front of you to stay invested in the market. So, for instance, if you are young, you have more time to remain invested in the market. That means that even if financial markets are going to experience some terrible years in a row, then you still have a lot of time in front of you for your stocks to recover. So usually it is recommended to have at least 80% of your portfolio invested in stocks if you are starting out. On the contrary, if you start to get older, you have less time in front of you to stay invested in the market. Meaning that if financial markets are going to experience some very bad years in a row, you have less year in front of you to recover from those losses. This is why a more balanced allocation of your portfolio is recommended. Something like 60% stocks, 40% bonds. These are just the general guidelines, and of course your decision about the portfolio allocation has to consider several other factors, like for instance your financial situation, your objective, your risk appetite, and in particular your level of knowledge about investing. Do you need a financial advisor to manage your investments? That really depends on your financial situation and your level of knowledge. I would say with so many online resources and low-cost robo-advisor is really easy. On the contrary, if you have a very complex financial situation with many assets and a very complex tax situation, then I would say that hiring a personal financial advisor might be a smart investment. But if you decide to go for an advisor, then I would strongly recommend you to go for a fee-only advisor, which means that the person you are gonna hire is gonna be paid for the amount of time and not for the type of product that he's gonna sell you. So to wrap up, here you go with my 3 tips if you are a beginning investor. Number 1, start early. If you start early, you give more chances to the money to grow and to work for you. The earlier you start, the earlier you kick off the compounding effect, and therefore you stand higher chances to grow your wealth. Number 2, stay consistent. Remaining consistent with your investment objective is much more important than the amount of money you decide to invest. Because remember, time in the market is much more important than timing the market. Number 3, invest in yourself. Investing in yourself is by far the investment that delivers the higher rate of return. And that's it for today. If you found this video useful, please don't forget to give it a thumbs up, subscribe to the channel, and pin the notification bell. Also, if you have some question, please use the comment box below. I would love to help you. That's it for today. Cheers and see you next time.